Better System Trader, Episode 20.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 20 and I'm your host, Andrew Swanscott. We have a huge show this week with Larry Williams as our guest. He's been trading futures and stocks for over 50 years. In 1987, he won the World Cup Trading Championships, turning $10,000 into over $1.1 million in just 12 months. That's a cool 11,000% return and the highest return to ever be achieved in that competition. 10 years later, his daughter won the same competition with a 1,000% return, and his students have won the competition in other years too. He's a published author with a long list of best-selling books and has also created a number of market indicators including Williams Percent R, Ultimate Oscillator, the Williams Accumulation Distribution Indicator, COT indices, cycle forecast, market sentiment, and value measures. In this week's episode, we discuss conditional trading, understanding what drives prices, the misuse of indicators and how to apply them correctly. We also discuss cycles, forecasting markets, what to look for in market tops, plus loads of listener questions where Larry shares tips and insights from 50 years of trading. It's a ripper of an episode, but just before we get started, a very quick announcement. To celebrate the milestone of releasing episode 20 of the podcast, we've organised a huge book giveaway where you can win an entire year's worth of trading books, plus lots of other prizes. Listen out for more details at the end of the interview, or if you just can't wait, go to the show notes page for this episode, bettersystemtrader.com/20, and you'll find more info there. Anyway, let's get to it. I hope you enjoy this week's chat with Larry Williams. Hi Larry, thanks for joining us today.
Oh, I'm glad to be here. I've been looking forward to this, Andrew.
Oh, thanks a lot. I'm sure most people know who you are already, but just to be sure, can you please give us a quick bit of background into how you got into trading?
Oh, gosh, it was greed. Way back in 1962, I saw the stock market crash, and I asked a friend what that meant. And he said, well, if you had bought this stock yesterday, that's up a point, would have made $100. And it doesn't seem like much now, but in 1962, $100 is a huge amount of money. You can buy a car for $100. And that got my attention. You can make money without going to work, without a boss. I go, whoa. I fell in love with that idea, and I have been ever since.
Oh, great. Yeah. So you've made so many contributions to the trading industry over the years, and we'll come back to some of those throughout the chat today. But can we just start by discussing your trading philosophy? Because I think I saw in another interview that you called yourself a conditional trader. Can you explain what that means?
Yeah, that's probably what separates me from other traders, as I've learned over the years that first, like probably a lot of traders, I was just taking buy signals and sell signals, but I didn't have them in the context of anything. A 3-day moving average crossed above a 7-day average. That was a big buy signal in the 1960s. And but so what? If you're in a bullish condition, not necessarily trend, but bullish condition, that signal is probably going to be enhanced and work better than if you're in a bearish condition. So finally, I got the notion that yeah, technical stuff works, fundamental stuff works, nothing's perfect in this business, but I need to have a conditions that are usually associated with substantial rallies or declines in the market. Then I can bring in the buy signal, sell signal, the technical mumbo jumbo stuff, but I need to put that on top of a condition in the market that says, yeah, we should rally based on essentially fundamental conditions.
Okay, so what type of fundamental conditions are we talking about here? What are you looking for?
Well, of course, it depends on stocks or futures, but I've noted primarily for futures, so let's talk about that. I have made indicators that give me a valuation model, so I can tell you if corn is undervalued or overvalued, or treasury bonds are undervalued or overvalued. So that would be one approach. Another one would be to look at the Commitment of Trader report, which I began that before anybody did, way back in the 1970s. More experience with that than anybody. And I think that is fundamental to the markets. And after all, the markets were set up to facilitate commercial business, not for us speculators. So the correct interpretation of commercials is fundamental. That would be one. Accumulation coming in the market by professional traders, I think that's fundamental to the market. Certainly spreads. My gosh, if you got a premium market in a natural resource market, it's hugely different than when you're at a discount market. So things of that genre is what I'm looking at.
Okay, so you mentioned a couple of tools there. You've got some indicators that you use and some reports. How did you come up with those ideas to use those tools to determine the conditions?
Well, the Commitment to Trade report, I had a guy come to me who'd been a member of the Board of Trade, and Keith and Kevin Campbell, who now run the large funds out of maybe the second largest funds in the world in Baltimore, had worked with Bill Meehan, and they said, Larry, you got to get to know this guy. And so I hired Bill, and Bill taught me really the idea of commercials, that these guys are not a timing tool, but they are a wonderful setup tool for when markets should rally or decline. So Bill was very instrumental in helping me work with the COT report. Then I started doing seasonals. I wrote the first book about that way back in the 70s, never been written about before. And then we started looking at premiums and spreads, and then I got the idea that all of these markets fundamentally are valued relative to the price of gold. So if gold is real strong and a commodity, say, is very weak, it's undervalued relative to gold. Or the other side of that, gold is down and say wheat is up, then wheat is overvalued. So we're able to develop a general valuation model based on the relative relationship of price of one future market to the price of gold.
Sure. So if we just jump back to the CAT reports for a moment, I know there's a lot of stuff out there on the internet which discusses how you use those, but can you just give us a quick basic rundown of that for people who haven't been exposed to that before?
Sure, it's a really great report. It's one of the few things our government does that I go, wow, they're doing a good job here. Every week we get the net positions, the longs and shorts, and the net position of the commercials. Those are the producers, the hedgers in the marketplace, the big guys. Then we also get the same data for the funds. Those are called large traders. It used to be people like myself that trade in large amounts, but now it's essentially the funds. And then we have what's left over, which is the public, small speculators. So you have small specs, large specs, and the commercials. Now, what people don't get is this is just not a number like a light bulb, it's on or it's off. Commercials respond to price structure. So they will buy at certain price levels, and you really need to put price into the equation. You can't just look at COT numbers. I mean, you can, but I don't think it's as effective. So you really need to look at total open interest. See who's driving open interest, the small speculators or the commercials or the large fund guys. So it really, people have tried to oversimplify this. I think it's best to tear it apart and look at how markets naturally move. And gosh, it's had some great major calls in these markets.
And have you found anything similar for the stock market?
Well, in Japan, they have a kind of similar index, what large traders are doing. It's very erratic. It's not quite as good. We don't have, of course, a commitment to trade report for stocks. So what I did is kind of interesting about maybe 18, 19 years ago. Since I worked with the COT stuff so much, I could develop an algorithm how commercials buy. I know how they buy commodities. They buy different than the public does. So I developed an algorithm that essentially duplicates the actual COT report. And then I thought, let's put that in stock prices and volume, and let's see what it looks like there. And what I found is it's a wonderful index for telling what a stock is most likely to rally or decline. It works in commodities, it works in the stocks, the same idea.
Right, okay. And can you explain, just then you made a statement that the commercials buy differently to retail traders. Can you explain that a little bit more?
Sure. The retail trader, who as we know essentially is a loser in the game, tends to buy strength, and they're afraid to buy weakness. Commercials, on the other hand, like to buy weakness, and they don't follow strength. They tend to sell strength. Now, you need to factor something really critically into this, though. As a commercial, let's say I'm Cadbury and I'm making candy bars. If the price of sugar goes down, I'm going to buy more sugar because my cost for that candy bar is less, right? So I have a habit of buying all the way down. So it looks like the commercials are very bullish because they're buying a lot. Yeah, they are, because they're taking delivery and they're taking that sugar, making a candy bar and actually having a higher profit because the price of sugar has gone down. It doesn't necessarily mean that they're wildly bullish about sugar. It means that they can make more money buying at lower prices. So you need to factor that element into the commercial activity, the natural tendency to buy weakness and sell strength. But that's really how what they do different, bottom line, between the public and the commercials.
Okay. And so once you've seen a condition in the market that could be pointing to a specific direction, what do you do then?
Real simple. I look for another condition. I don't want to trade on just one condition, like seasonals are a pretty good thing to trade with, not always though. So that would be one. Then I'd like to look at commercials, then valuation, then maybe a couple of my other indicators I've developed, accumulation measures, spread relationships. Oh, look, I got 3 or 4 of these things here. That's like a tumbler and a combination lock. I get one number, go back the other way, come the other way. I got 3 numbers in place. The lock's probably going to open up. So then I'm interested in the trade. But first, it's not just one condition, not just 2 conditions. I'd like 3 or 4 conditions to really get trades that work.
Yeah, right. So you've actually, you mentioned indicators there. You've come up with quite a few unique indicator ideas. How did you come up with those ideas in the first place?
Drink a lot late at night.
Excellent. I think I can do that too.
Oh, when this has been my life. This is all I've done for 54 years. You just look at these stupid charts. So after a while, you kind of get a notion. I've been really blessed to have friends like Tom DeMark, who's given me some great ideas to work with. Tom and I developed sequential together, and he went off and made a whole career out of it. And so have friends like Jake Bernstein who have ideas. So kick ideas around. I read everything, still read everything. I believe Ronald Reagan, though, said trust but verify. So I read it, but it doesn't mean I believe it. I need to verify it. But this is the compelling passion in my life. So I investigate. I think about things. Fortunately, I started as an art major. I don't have a background in math or finance at all. I didn't understand that. Nobody in my family ever owned stocks. But as an art major, you really learn to look differently at things. You learn to look at little blades of grass and lighting and shading. And I think it was a great background to look at charts. And, oh, I see things in charts. Other people say, oh, I never saw that. And to me, it's like, well, yeah. So I'm just, there's a natural thing, I guess. Some people see, some people are better with math. I'm miserable with math, but I have a pretty good ability to look and see things.
And I think as well, because when you open a charting program or some software, you look at the indicators and there's literally hundreds of them. And, it's very tempting just to throw them all on a chart and see what sticks. What do you think about the way people use indicators today?
Most all of these indicators, including mine, are redundant. So if you have stochastics on, and RSI on, and a commodity channel index on, they're all saying essentially the same thing. So you have too many things to look at. First of all, you're multitasking, and that's, of course, very difficult to do. And they're redundant. Bollinger B band looks like my percent R. There's no difference between them. So I think, fewer indicators, that's huge. You don't want, I see people with 15 indicators in their charts and go, oh, loser.
Yeah.
The other thing is these indicators need to serve a purpose. People just go, oh, they indicator crazy. They're addicted to indicators. There should be a purpose of the indicator. It might be to measure accumulation. It might be to measure trend. It might be to measure cycle. So people don't think about, well, what is this indicator supposed to do? And that's where we need to say, look, on my charts, I have an indicator for cycles. I have an indicator for accumulation. I have an indicator for commercials, indicator for valuation. They all are looking at the market from a totally different viewpoint as opposed to, oh, look, I got RSI and percent R on. So what? They're redundant.
And what about particular trading styles? Do you think there are some indicators that lean more to particular styles than others?
Yes and no. But I want to talk about styles for a moment because that word is really critical. My son's a psychiatrist trained at Johns Hopkins, and Jason wrote a book, The Mental Edge in Trading, where he interviewed highly successful traders. All the rest of the clinical work has been done with losing traders. Jason just looked at world famous traders with great track records to see their styles and their personality profiles, if you will. And what he found in that research is that none of these traders had the same style of trading, A. B, all of them had to kind of wander in the forest until they found the style that fit them. So ultimately, you don't trade the market, you trade your personality. So for somebody to say, well, I'm going to trade like Larry Williams or whoever, that may not fit you. You need to find the style that's compatible with your personality, your time frame, where you live, all that stuff.
So I guess the next logical question to that is, how do you do that? How do you find a style that matches your personality?
Well, you could do a personality profile if you want to get clinical about it. A lot of people do that. I like to say, well, there's a couple of things going on. When you're young, I'm 73 years old, so I don't really care to day trade anymore. I can do it, it's a lot of fun, but there's no big money in it, and I have enough money in my account. I don't need to day trade. So it depends on your lifestyle or life cycle. Probably when you're young, you tend to be quicker and faster, and you can sprint faster for sure than I can now. And I just did a track meet in Montana. My gosh, my time is disastrous compared to when I was in high school. So if am I a long distance runner? Am I a sprinter? Am I a middle distance runner? How quickly do I respond? Those are internal questions. What's my time frame? If you live in Australia, you're going to go to sleep at 10 or 11 o'clock at night, place your trades, and wake up in the morning. You can't day trade American markets in Australia because you can become a zombie. So you need to look at all those things, just introspection into yourself, your lifestyle, how you approach things in general. That's going to give you a direction of the style of your trading.
Okay, that's some great advice. Thanks, Larry. Now, I'd like to move on to market forecast because it's something that you've been doing for decades, and I guess a lot of people are skeptical about forecasting the market. So, the first question would be, can the markets be forecast with any degree of accuracy?
Oh, I was going to say yes, they can be forecast, but then you had to put that degree of accuracy stuff in there, didn't you? Andrew.
How about I start with, can the markets be forecast?
Oh, yes, they can be forecast. They can be forecast 100% of the time, but what's your accuracy going to be, right?
Yeah.
That's the rub. To which my reply is, generally speaking, we can usually forecast a general roadmap that a market will take. My forecast for this year was a sell-off in crude in the middle of the year, that we would be in a bull market in stocks, and we just recently made new highs in stocks. We forecast a bull market in China a year and a half ago, and we've had a big up move in China. So generally speaking, yes, but can I call the market of the day 3 years in advance? No. I'm going to tell you right now, we're going to have a significant sell-off in the middle of 2017. That's going to happen. That's based on long-term cycles. Can I tell you the day? No. Can I tell you the week? About, but probably very general. So you need to understand cycles give you a view of the roadmap, but I don't think any of my forecasts or anybody else that I've seen are so prescient that they nail the exact high and low. They may occasionally, but that's luck. That's randomness. But I have found, and so my readers, that the forecasts are really helpful because we know the overall trend. We're going to start the year here, have a major buy or sell here, and end the year there. If I have that vision, I'm way ahead of the crowd. In the land of the blind, the one-eyed man is king.
So when you say cycles, are you talking about seasonality there?
Partially. I do look at seasonality, but it's very ephemeral. So I've done a lot of work developing cyclical components. As an example, there's a pretty good 10-year pattern in stock prices. If your listeners will go back and look at soybeans in 1973, when I first made my first $1 million trading in futures, and then look at soybeans in 1983, 1993, 2003, 2013, all those years had big bull markets, especially in soybean meal. So I think probably 2023, we're going to have another bull market in soybeans and soybean meal. So I look at things like that, but it's really based on a huge amount of work in the past to find not just cycles as such. We have a low every 18 months. No, we don't. But the pattern of how these prices trade. That's one thing. The next thing that I'll do, it's really fascinating. It takes a lot of work, but it's a pretty interesting observation. I will look at the last 12 months activity in any market and get the highs and the lows and the general path the market took. Then find all instances in the past when the market had that same pattern. Once we have that established, we then can go in the future from all those patterns to see how generally price moved after we had that pattern. So those pattern analogs can be very helpful to a trader to point when the next market highs and lows are going to occur.
So with that soybeans example, how do you get around having such a small sample size when you're looking at cycles at that kind of duration?
I'm not a big believer in sample size. I know that flies in the face of math, and I'm the guy without a background in math, but I explain it this way. I developed a system for trading coffee. It had over 1,000 trades in it. We started to trade it, and it immediately fell out of bed. So it had sample size, had all the good numbers you could possibly want. It didn't work. If I walk outside my house and I see a Doberman pincer out there next to a white fence and the dog bites me, I go to the hospital to get repaired. I come out, heal up, I walk out, and I see a Doberman pincer next to a white fence. Do I have to do this 30 times? Statistically, I'm supposed to, but no, if there's an event there, a Doberman, then that's different than, oh, just massaging a bunch of numbers, because these commodity numbers are like prisoners of war. Beat them often enough, they'll confess to anything. You make anything out of these numbers. So I am very concerned, as we talked about originally, a condition. If I have these conditions, and then I can start to look at building a trading approach from that condition.
So I'd just like to ask you a little bit more about forecasts, because earlier you mentioned you forecast the move in oil this year. Do you have any specific forecasts that you'd like to mention now, perhaps the stock market, interest rates, or gold?
Sure, we're in a bull market in stocks, and we're going to go higher. There's a buying opportunity. Any dip in here you want to buy. If we get a dip, the whole strategy for 2015 is buy the dips. We're in a bull market, and this is going to continue. And don't listen to the Cassandras. And I think we're going to have a substantial rally coming in in the stock market, not just a little rally. There's a big move coming in this market. That's based on fundamentals. So that's market one. Market two, gold. Seasonally, we're at a seasonal low in gold. We usually rally here, but not this year. My cycles and my fundamentals say no, we're still going down lower. Probably a decent buy point coming in October for an intermediate term rally, but most likely around the $650, $700 area in gold is where we're going to find the real bottom. The seasonal guys are getting sucked in here, in my humble opinion, and I've been wrong before and I'll be wrong in the future, but that's the forecast. Finally, in interest rates, we've said all year long, lower interest rates, buying a break in the bond market because the Fed's not going to lower interest rates. And this market, especially right now, is incredibly bullish based on cycles and seasonals. Into October, then we start to have a pullback. And finally, to kind of bring this together, the big fear right now is, if the Fed raises interest rates, what will that do to the stock market? This is my view. If and when the Fed raises interest rates, I don't think they will this year, by the way, and that's been our view since January. But if they do, or if they do it next year, when they announce an interest rate increase, stocks are going to crater. They're going to get hit hard, and you want to buy that weakness. The first increase in interest rates following a substantial decrease in rates or a flat period in rates is very bullish for stock prices. And the reason for that is that people have been on the sidelines, not borrowing money, not expanding their business. And once they see rates start to increase, they go, oh, well, I guess I better go borrow money now so I can do more research, development, build a building. They're starting to increase rates. I better borrow money now before they take them higher. So people are goosed into borrowing because they see that first rate hike. They borrow that money, and that money doesn't sit in their bank account. That money goes into consumption and production. So I think that when we see that first rate hike, it's a real buying opportunity in stock prices.
Thanks, Larry. So some of those were quite specific. For instance, you said, I think it was gold in October around, I can't remember the price. I think you said 650 or 700. Have you actually tracked how accurate your forecasts have been over time?
Yeah, the best way to track how accurate they are is how many people continue to renew their subscription to my annual forecast. That's the best way. Well, we just did a media review where we show all the forecasts so we can see. I would say roughly that, depending on how you describe accuracy, about 80, maybe 85% of the forecasts generally got the big upswings and the big downswings in the marketplace. Again, not to the day, but we generally know when the highs are going to be and when the lows are going to be.
Oh, that's interesting. So you've also been quoted as saying certain conditions are synonymous with market tops and bottoms. Can you share what some of those are?
Yeah, this is really interesting. I'm going to prattle for a little bit here, so bear with me,
Sure.
Andrew, because there's
Yeah.
a big difference. Technicians think that a buy signal should be the same as a sell signal. It doesn't work that way in the stock market. Fundamentally, markets take a long time to top out. The markets move up and up and up, and then the economy starts to deteriorate a little bit, a little bit, a little bit. Then stocks decline. Tops take a long time, and they're caused by fundamentals. That's fundamentally we get tops, and I'll talk about indicators for that in a moment. The way bottoms are made, you look at any bottom, the market crashes, sells off, plummets, and then immediately has a big expansion rally off that low point, comes up, holds, and then takes off again. So bottoms are made based on panic. They're almost instantaneous. You've got 1 week to be a buyer right at the bottom. That's about it. So bottoms are formed and structured differently than market tops. That's a huge difference.
Mm.
Technically, you can call market bottoms with most any technical stuff. There's all kinds of stuff. Tops, though, a whole different ball game. I can't find much technical stuff that does a good job of calling tops. So I got the notion, well, then let's look at fundamentals. And fundamentals do a good job of calling market tops. Where they don't really call market bottoms, you're undervalued, but you can go undervalued for a long time.
Yeah.
So you really need to look at both sides differently, tops and bottoms for buy and sell signals.
And what type of fundamentals would you look at for a market top?
Well, the most important one probably would be the yield curve. I'd like to look at yield curve. I'd like to look at 12-month forward PEs to get a sense of what's happening to PE ratios. Also, net pre-tax earnings by companies. If the pre-tax earnings are increasing and increasing, I don't think you're going to see a bear market. If those pre-tax earnings start to decrease, they're going to see higher PE ratios, and it means they're not selling stuff, and we're going to have problems. Very Those would be some major ones.
All right. Well, we might move on to some listener questions now. The first one is from Raul, and he says, in the past, you've said Forex is a scam and have recommended futures over Forex. Do you still believe that to be the case? And if not, which of your products are compatible with Forex?
Let me rephrase it. Forex as a market is a legitimate, quasi-legitimate market. It's not a regulated market, so I have problems with that. The scam is not that you can't trade in Forex, but the brokers, if you will, the hustles that are out there trying to sell perfect Forex trading systems and brokerage. So that's where the scam is. Yeah, Forex is a legitimate bank. For banks, it's a great market. But to think that we can come in and trade that market, that's a big sales job. And here's why. The commissions you're going to pay in the Forex is like no commissions, but you got to pay a pip in and a pip out. So that might be $20, might be higher. Some are going to charge you 2 pips. I can trade the exact same thing in Globex or ICE for $4.50. So my cost of business in the Forex is 3 or 4 times higher than my cost commission, my cost of business in a legitimate regulated market. Plus, when I did trade Forex, I had the market one night I was trading in Italy. The market went through my price. I had a limit order below the market, went below my price, came back above, rallied, and I never got filled. I go, I don't need this. It's hard enough to make money. Market went to my price, one tick below it, and I didn't get filled. On a limit order, that's impossible in a regulated market. So, yeah, Forex for the banks is a good market to trade, but I don't know of any really serious long-term winners publicly that are trading. Plus, in the Forex, the big advantage is 100 times margin. Well, I have more pride for somebody selling and more respect for somebody selling crack cocaine on a street corner than somebody offering 100% margin. You're going to lose all your money with 90% margin. It's like crazy. This is why people blow up. They start with. I had a guy the other day, Andrew. He had $90 in his account. And he's trading Forex, and he got stopped out. I go, well, you need to have a bigger stop. He said, I can't with $90.
Oh, dear.
Yeah, that's sad. Oh my gosh. So it tends to appeal to the pecuniary interest of people who make money quickly, instantly, and you don't need much. Well, you do need the number one cause of failure in business is lack of capital. That's it. Doesn't matter what the business is. Well, guess what? You can start trading with $250 on 100 times margin or 50 times margin. You might as well give your money to the Salvation Army. They're a great group. They really help people, and you'll know where your money went. You'll feel better about it.
Yeah, well said. Thanks, Larry. A question about price patterns from Michael. He'd like to know, what is your opinion of trading using price patterns that have a demonstrated track record of generating profits but do not necessarily reflect a fundamental understanding of market behavior?
Well, I think he mixed his metaphors there. Let me talk about that a little bit. He meant a fundamental aspect of market behavior. I think, and I could be wrong on this, but this is my view, okay, that all these price patterns that we see, these price actions, charts, if you will, are reflection of human emotions. So I think chart patterns are valid because they're an emotional response. And if we understand the emotions of those patterns, they're repetitive. Your team wins the Super Bowl, you're happy just like you were when they won it the last time. So emotions are repetitive. So I think price patterns are very, very helpful. And it's all about finding these patterns that represent an emotional, cathartic experience of traders, and usually doing the opposite of whatever that emotional experience has been. So I think these short-term patterns are. I mean, I've made a lot of money with them, millions of dollars with them. So yeah, to me, they're instrumental in what I do. I think there's a lot of trailheads there in those price patterns.
Thank you. And a similar type of question from Craig. He wants to know, do your short-term strategies still work in today's algo-driven markets?
Oh yeah, they sure work because they're based on emotional responses to the market. A lot of people concerned about all the algorithms trading the high frequency traders. And maybe just I'm an old man and I don't really care. These guys are in and out so fast. It doesn't matter in my world. We just recently started a mechanical Russell index trading strategy at Robin Trading Company. I think we've had 4 or 5 in a row, winning trades, no losers, very little drawdown, using these old patterns I wrote about back in the 1970s. So I think that the markets, the big change though, and this is an important point, the markets changed in 2002. That's a critical point for anybody doing research. Prior to that, we had pit session markets. 2002, we went into electronic sessions. So a lot of things changed back then. And that is a declination that you need to look at as you do your research. 2002, electronic markets, you need different timing. You need to revise your strategies from that point forward.
A question from Chris. Chris says, an experienced trader once told Larry that the big money is made trading relatively small positions for a long time. How did Larry first see this manifesting in his own trading?
Well, at first, I don't know that I rejected it, but I was young, I was fast, so I wanted action, in out, right? And finally, uh, it got to me one time in particular where I realized what Bill Meehan told me. It all came together with this. First of all, if you don't have a trend move, there's no profit. So trend is the basis of all profits. No trend, no profits. It doesn't matter if it's real estate or pork bellies or whatever, gold, doesn't matter. No trend, no profits. So I thought about that. Okay, so what's a function of trend? Time. The more time you have, the more trend you can get. And then I had the cognition that, yeah, Bill was really right because a day trader's time is 3 hours, 4 hours, in the DAX 6 hours. That's it. That's all the time he has. So the only way to make a big killing in a day trading situation is to have a big position. If you have a big position, and I've had up to 4,000 bonds at a time on my big positions, short-term trading, the big position, you're going to have a big loss. It's going to happen because not all your trades are successful. So the opposite of that is to have time on my side. Hopefully I can catch a move of 3 days or 15 days. Then I can have a small position and catch a big move. The mathematics of that is substantially different than the mathematics of big move, a big position to make a lot of money, because the downside is bad. So I really believe that the best way to be consistently successful is a relatively small position and capture a big move. Time is really our ally. Time's our friend.
I've got a couple of other money management questions here, but first, just a trend trading question from Mark. He says, it is well known that there are periods of time when trend trading is not effective. Do you ever foresee a day when trend trading stops working permanently?
No, we'll always have trends, but I'm not much of a trend trader as such, just because you can see times periods where the market went into a choppy or detrending market, no trend market for 2 or 3 years. That doesn't work for me. I've got to make money trading, so the fund can handle that and live through it. But as individual traders, we really can't. So there will always be trends someplace. There's always shortages. There's always wars and disasters, feast and famine. That's what makes our business so exciting. That's what causes trends. There will always be trends, but um, that's a long-term player's game. It's for people that manage money. For the average trader, we've got to catch intermediate-term swings in the marketplace, as I see it. And again, I may be way wrong on that, but I think we're all about catching intermediate-term moves.
Okay. And a question from Joe. How many positions should I have on at one time? I've been told that I should trade small and trade often to increase the number of occurrences, and also to just trade 8 positions with equal dollar amount so it's easier to manage. What do you think is correct?
Well, Joe, all I can tell you is about Larry Williams. I don't know you, I don't know your psyche, but I'll tell you this about Larry is that if I get on 4 positions, I get scared because that's a lot of positions for me to have. Invariably, if I'm looking at copper and the bonds move, so I take my focus away. I'm trying to multitask again. So in my case, 4 positions is about as much as I want. Plus, I'm risking 2% of my money on each trade, so 4 times 8, 2% on each trade. So I've got some exposure in the market. I've got 10, 12, 15% exposure in my total account. So for me, and maybe not Joe, but for me, and I'm not a rocket science guy by any stretch of imagination. 3, 4 positions, that's plenty. That's plenty of hot trades for me to have on. So it's really about you as opposed to just the mathematics of the market. Yeah, in theory, there's probably some optimal number, but you got to bring yourself into that equation.
And a similar type of question from Peter. How can we learn more about money management formulas? And then in brackets, he's got, if we exclude Ralph Finch since his work is too math heavy.
Well, I would say that the best place to go to learn money management is Ralph Vince. Ralph is. And now here's the interesting thing that people don't know about Ralph. I'm spilling the beans on Ralph here. Ralph has been a dear friend of mine for 30 years, 35 years. We ran the Boston Marathon together. Um, Ralph never took a math class in his entire life.
Wow,
Yeah,
that's incredible.
it is, isn't it? His book is used in college classes. He's didactic. He learned all that on his own. And you talk with Ralph, you wouldn't have any idea he's a mathematician. Might think he's a plumber or something. He's just the greatest guy in the world. He's an amazing person. So, but I understand because I'm not a math guy. I got weighted down in Ralph's books. There's a lot of struggle. I think you can boil it down to this, at least for me. Okay. First of all, you want to have small positions to catch big moves. Secondly, there is an optimal number that Ralph has found that will maximize terminal wealth. That number is about 25%. If you risk about 25% of your money on each account, that's optimal wealth. But it's optimal drawdown too. I think for the average trader, the maximum you should risk on a trade is between 2 and 4%. And I have made millions of dollars with that 2% risk factor. So that's my approach to it. If you want to be, if I was trading in a trading championship, that's different now because your only concern is winning. You don't care about blowing up. When my daughter won it, the World Cup Trading Championship, she traded with a 10% risk factor on every trade. That's ample to win a trading championship. But you can blow up. For the average trader, 2 to 4% bet size. That's what it all boils down to. And here's why. Because if you have consecutive losing trades, and we all do, if you have 4 consecutive losing trades with a 10% bet size, you're down over 50% of your account in just 4 trades. With a 2% bet factor on 4 losing trades, you're down about 16%, maybe not even that. So you're still alive. It's all about staying alive.
Well said. A question from Samant. For optimal portfolio returns, I believe one must select the fastest and least volatile markets for trading. How do you quantitatively determine the optimal markets to trade?
Well, to me, see, I see it a little different. To me, the optimal market is the one that's the most set up right now. And it may be low volatility, it may not even be doing much action, but it's fundamentally really set up to have a big up move or down move. So I'm all about, people always ask, what's your favorite market to trade? Well, it depends. It depends on what's set up to move right now. That's the one that I'm the most interested in, the market that's the most set up.
A question from Wei. To gain an edge in trading the markets, does the retail trader need to invent new ways of analyzing the markets? For example, inventing new indicators, or new ways of analyzing markets using existing indicators, or simply just follow the tried and tested ways from a successful mentor? The reason for asking this question is that the markets are always evolving, and edges in any system a decade ago may no longer be profitable today. That's a long question.
Yeah, I'm going to try to remember the different pieces of it. First of all, I'm not a big fan of mentoring. I think that mentoring, by and large, doesn't work. And maybe that's just me because I don't see how in the heck I could take hours out of my life to hold somebody's hand and bring them through the wall of fire here. I mean, I've done it with a few people. That's a serious proposition because you're responsible for this person, for their mental health, for their financial health. That's a hell of a responsibility to take on. So the idea you can mentor people, maybe you can coach them a little bit, but mentoring just scares me. And I've also noticed, my son's research shows that every successful trader trades differently. Every football player that we have in America, American football, they all throw the football differently. They're all great passers, but Joe Namath didn't throw the football like Tom Brady with those deflated balls, and they didn't throw like Joe Montana. So you have to find your style, and for me to impose my style on you, as mentoring would do, I'm very, very leery that mentoring really works. It's a great marketing technique and tool. We'll mentor you. We'll make you like whoever. Way too much responsibility for me to take on that much control of somebody else's life. First point.
Mm.
Okay, second point. The markets, you can trade the tested and true, I think was the language that he used there.
Yep, tried and tested.
But how do you know that it's tested? How do you really know that it works? That's my point. That people will say in a book, oh, this works. Well, let me tell you, there's a lot of stuff in those books that just, the markets never read those books. The markets don't respond that way. So yes, if it's tested and it works, sure, you'd want to trade that. But I would not accept anybody's view, including Larry Williams. I wouldn't trade Larry Williams away until I tested it, because if you test it, then you have confidence in it. I used to manage heavyweight fighters. The ones that won were the ones that got in the ring with confidence. They'd trained hard, like they're ready for the test, they're ready for the exam, they're ready to rock and roll and rumble tonight. They had confidence. If you don't have confidence as a trader, you'll get out of your losing positions that would have gone profitable too soon. You won't have enough positions on. So you have to have confidence in it. So that's what testing does. And paper trading does. It gives you confidence in the system, and most importantly, confidence in yourself. So that would be my off-the-cuff answer. I don't think you need to develop new indicators. I think there's too many indicators out there. You need to have indicators that we mentioned earlier that serve a specific purpose. You need to understand charts don't move the markets. Conditions drive prices. Charts don't move the markets. We can find these short-term emotional patterns that I talked about, and you'll get nice 1 and 2 day pops in the markets based on doing the opposite of the emotions. But by and large, charts don't move the markets. Conditions causes markets to move.
Yeah, that's a good thing to keep in mind. Thanks, Larry. Just a couple more questions, if you don't mind. One here from Marcus. Marcus says, if you're only allowed to use one Larry Williams indicator to help you trade intraday, what would it be and why?
I wouldn't do it. I think day is a loser's game. That notwithstanding, if I was forced to just trade one, I wouldn't, because I would want two. I would want one indicator that would tell me that I'm qualified conditional for a top or a bottom. I should rally or decline. I would want that condition. And then I'd want an entry or trend mechanism. So again, it's back to my theory, which is just my theory. Sometimes reality diverges from my theories, but my theory is I need a condition, and then you need a trend change that confirms that condition is now present and operative.
And would your answer change if you were looking at a different, perhaps like a swing trading style, longer term?
Uh, I would want something to confirm that conditionally this market should rally or decline, and then I would want to focus on the technical trend change, pattern setup, technique, whatever that's going to give me my entry. I want a condition, and then I want something to help me with the entry, some form of a trend mechanism.
Okay. And a question from Martin. He says, you've been doing this for a long time. What keeps you motivated to get up in the morning and keep putting on new trades?
Well, there's a couple of things. This is all I know how to do in life. I don't know anything else. I tried other things, by the way. I used to own a bank, manage heavyweight fighters, owned a big medical company. All those things were good, but you know what? I wasn't very good at them. I managed money for a while. Oh my gosh, you got to have lawyers and go to meetings and coats and ties and vests. I'm not good at that. I'm pretty much a free spirit guy. So this is my life, and I realized that maybe about 15 years ago. So this is what you do, Williams, and you better be happy doing it. So the motivation now is, I've got enough money, I wouldn't have to work ever again. But the motivation really is to be better, and I think that's the way it is in any um, peak performance is not driven by money. Peak performance is driven by a huge passion to get better at this, to be the best it's ever been, which I'm not even close to it, but I'm working on it. There's a lot of traders a lot better than me, but hopefully I can get kind of into that arena at some point. It's really all about learning. Just so fascinating. This whole subject is, from the first time I first look at a chart, I go, wow, this just grabbed my heart and soul, and it still has my heart and soul, and the passion to be just a little bit better at it tomorrow than I was yesterday.
So looking back on your success, what do you think was the most important thing that kind of turned everything around in terms of achieving success in trading?
Well, I think money management. Um, let's say to be a consistently successful trader, that was a big turnaround point. Meeting Bill Meehan, meeting Tom DeMark, meeting a lot of people in my life. This industry is phenomenal. The friends I have from all walks of life, from my buddy Vic Niederhofer, Tom, Jake, all these people, John Hill over the years. Oh my gosh, what an amazing group of people. John Bollinger, what a great guy. To be able to talk with these people, learn a little bit from them, that's been huge. But really, I think understanding bet small, catch big trends, manage your money, quit being a cowboy. I think Paul Tudor Jones called me a kamikaze cowboy trader. I don't know what it was. I traded. It was like a lot of fun. I used to ride rodeo, so I didn't mind getting bucked off horses. I knew, that was half the fun was the pain, getting back on again. Finally, I woke up one day and said, it's nice, but I'm just cycling over and over. So you better figure it out. Back then, nobody had written about money management in the 1960s. There was nothing on the subject. We didn't have a clue what we were doing. Traders are so blessed now. They have computers, they have indicators, they have money management. We didn't have it then.
So why do you think you've lasted so long in the trading industry?
I think my survival instinct as a person is very high. I think you can put me any place and I'm going to survive. Some people have a survival instinct, some don't. Fortunately, I grew up in Montana, lived in the woods, and we were regularly tested going out in the woods and given a match and an egg and a slice of bread and say, come back in 5 days. So that physical experience, which is great because it makes you think more, I think, about survival. So that was good. I don't know. I'm blessed. I'm absolutely been blessed to find my passion in life have a little modicum of skill at it, not enough. But and understanding that money management, you blow up because you bet too big.
Well, just two more questions from the listeners and then we'll move on. Nick would like to know if you have any advice to traders starting out on psychology around pulling the trigger and staying longer in winners.
Nick, the reason you're afraid to pull the trigger is you're lacking confidence. We talked about that earlier. Confidence comes from repetition. Mastering any subject is a function of repetition. So you need to repeat this pulling the trigger, whether it's paper trading or you're getting emotional as you pull the trigger. And you're getting emotional for really three reasons. One, you're going to lose money, may lose money. Two, you're going to lose sense of self-worth. And that may be bigger than losing money because, if you got to tell your wife you lost money today and she's going to ask and you're going to look like an idiot, or your brother-in-law made money and you didn't. So there's a huge emotional thing about our egos when we lose money. So that's a big part of it. And your bet size controls your emotions. If I'm betting 100 contracts, buying 100 contracts, the S&Ps, my emotions are higher than if I'm doing a one lot. A one lot to me is like, OP, no big deal. But 100 lot, a 200 lot, that focuses my attention. It increases my emotions. So your emotional bet is too large. So your bet size controls your emotions. So maybe that will help you understand it's easier to pull the trigger when your emotional response is not as high. So it may be your bet size that's overriding your emotions, or you haven't done this often enough to systematically desensitize yourself from the emotions of putting on a trade.
Okay, thanks for that, Larry. And a final question from Eric. Eric asks, your 30-year T-bonds account at World Cup Advisor shows a minus 28% return since its inception in 2014. Do you have any lessons from that?
Yeah, sure. I don't know those are the numbers, but I'll accept them. Some of the signals didn't work. So what we do is go back and see which signals did work and which ones didn't work, and get rid of the ones that didn't work and look and study it, because this is an ongoing process. And that's all you can do with it. There are no straight paths to heaven. And 28% decline, yeah, well, I don't like that, but I've taken all the trades. And do I believe that it can turn around? Yeah, I do. I have to pull up my chart. I don't think that's quite what it's done, but yeah, that's you better get used to that. People are pre-framed to have instant success trading with systems and all this stuff, and that's wrong, because you don't have instant success. You better pre-frame yourself that you're going to have troubles in your trading, or that's where the problems come from, because you think it's going to be a straight path to heaven, and it isn't a straight path to heaven. So if you're not willing to sit through some type of a drawdown, then you shouldn't be trading. Yeah, we had a drawdown in 2015. We've come back recently, but we're higher now than we were last October, higher now than we were last May or last 2014. So that's markets. If you expect this a straight path, you're in the wrong business.
Yeah, well said. Okay, we'll just start to wrap things up here. If I can just ask you just a few more questions, because you've had a really impressive trading career so far. You've contributed a lot to the trading industry. What do you think was your most important contribution?
Probably opening the door to money management. As I said back in the day, there was nothing on money management. We were literally stumbling in the dark, and opened that up. That there's all these indicators and conditions and all that stuff. It's well and good, but if you don't manage your money correctly, it doesn't matter. You're going to probably lose. So I think that in terms of that would really be the largest contribution. All the indicators that developed, my students that have won the trading championships consistently, it's my guys that win all the trading championships, my students. That's the next biggest feather in my hat. For me to win a contest, yeah, big deal. Okay, I should. I've been around forever. I'm older than dirt. but that my students can win these contests, that shows that knowledge can be transferred, and knowledge can trump emotions of traders. If they learn correctly, success is there. That to me is a huge statement about this business, that it isn't just there's some skilled people out there that get lucky. The fact that for 20 some years now, the winners are my students suggests to me that it is possible for the average guy to do really well in this business, and knowledge can be transferred.
Yeah, and a lot of the strategies that you've come up with over the years have really lasted the test of time as well. So why do you think that is?
I think it's because I've always tried to I've done two things: simplify, not make it complex, simplify. The higher the truth, the simpler the answer, I believe. And get to fundamental things to get to causation, as opposed to, oh yeah, look at this in the chart. That happened once. Well, okay, then I'm going to test it and find it out for 1,000 times to see in 1,000 times if it has. But I really want to get to what causes markets to move. The commercials, the accumulation in the marketplace, the cycles, all the stuff we talked about. Markets move for reasons. And until you stop doing this all technical mumbo jumbo stuff and get to the reasons, I don't think you're going to be a highly successful trader. You have to get to the reason, the cause of price movements, and then you're pretty much in phase with the markets.
Yeah, okay. Well, I'd just like to wrap up now with a few quick closing questions. What's the biggest lesson you've learned through trading?
Humility.
Okay, that's a good one. What do you think is the hardest part of trading?
Being humble when you're winning.
Fair enough.
Yeah, I mean, in my best years trading, I was a jerk. I really was. And I see friends of mine that get real successful and they're jerks, and then they get a lesson of humility and they're really nice guys again. So I think that's one of the big psychological lessons. It's real easy for me to be a jerk, and I try not to be, but oh my gosh. Uh, I'd say that's part of it, and maybe learning from other people. I'm looking at our bond trading at Robbins, and I don't see the numbers that the person was talking about. I show for this year as an example, we're up $7,000 on 16 trades with 75% accuracy. Last year, we had 27 trades, we made $12,000. So I don't know where that 28% drawdown came from. I just looked at the system. But anyways, here's the other thing I got out of all this. Again, I'm the artsy craftsy guy. I was an art major, kind of confused. I went to college on a football scholarship, but was an art major, wearing pastel clothes and going to pastel painted clothes, going to football practice and beating people up. But so I didn't understand research. I didn't understand scientific approaches back then. And fortunately, I got that real early, that you need to test and research and find out. Just because Larry Williams or somebody says something's meaningless, you've got to test and verify. It's just all about research. The more you know, the better you'll be. It doesn't matter if you're a doctor, a lawyer, a plumber, a ditch digger. The more you know what hoe to use or what shovel to use, the better you're going to dig your ditch. So it's all about knowledge. This is knowledge-driven business.
Now, this next question you kind of touched on when you were talking about the studies that your son Jason did earlier in the interview, but what do you think is the most important ingredient to becoming a successful trader?
Lack of confidence.
Lack of confidence.
Yeah, one thing that Jason noticed about all the traders is that's not quite the right word, so let me talk about it a little bit.
Sure.
That all of these highly successful traders did not have the persona that you would expect. You've seen the Eddie Murphy movies, Trading Places, and buy New York, sell Chicago, and yell and shout and scream. That's not how these guys are. They have two primary quotients that Jason found. One was that they're a little unsure of themselves. A good example, my neighbor here managed about $1 billion in his fund. And I asked him to speak to a group of traders one time. And he said, well, I've only been trading like 20 years. I don't know what I could tell him. He has a very low, like you would tell him a lot, right?
Yeah.
But they're
Wow.
very almost self-introspective. Now, what Jason and I think that why that's effective is because then they never bet big. It's the guy who thinks he owns the world, King Kong feeling, that's going to make big bets, and big bets you'll lose big. So I think that's part of it. The other thing Jason noticed in his research is that none of these people responded had high levels of emotional response. Another trader I can think of is married to the wife from hell. Man, this woman is just like crazy. He loves her, doesn't bother her at all. Everybody else gets around her 2 minutes ago. Oh my gosh. But he doesn't have a high emotional response to things. And Jason found that with other traders. These very successful traders, you could whack them in the face and tell them that, the end of the world was right here, whatever. They go, okay, I'll deal with that. Whereas the average, oh, what do I do? I want to jump off the cliff. The Fed raised
Mm.
interest rate. They get all emotionally rattled. These guys don't get emotionally rattled, just as their basic personality. So those are two traits we can learn. One, don't get emotionally rattled, and B, have confidence, that internal confidence I talked about, but be willing to be a little unsure, because then you'll never bet big.
That's an interesting way to look at it. Thanks for sharing that, Larry. What about, do you have a favorite trading book or books?
Yeah, I do. My favorite trading book is a Zurich, like the town in Switzerland, Zurich Axioms. I just so well written. I wish I could write like that. Oh my gosh, it's well written and it's drips with um, knowledge, not about I want to buy tomorrow, but just in depth understanding of this business. So it's by Max Gunther, Gunther, Zurich Axioms. It's a great book. I reread it I used to read every year, now maybe every couple of years. It's got a lot of wisdom in it, just drips with wisdom. Of course, everyone usually says Confessions of a Stock Market Operator. That's a good book. It's an exciting book. Maybe it's too exciting. And you got to remember that the person that supposedly is written about, Jesse Livermore, ended up committing suicide in a hotel in New York City. His son shot his wife, and I think one of the wives shot the sons or whatever. I mean, it's like if that's where trading leads, I don't want to be a trader. So, and I think a lot of people aren't fully aware of Confessions of a Stock Market Operator.
And what's the best way for listeners to get in touch with you?
I prefer they don't and retire. But if people wanted to, our website is ireallytrade.com, and we'll keep that up for a little bit longer. This year I'll be in China in October, then Russia in November, and next year we'll probably do one more grand finale, and then that's it. We're going to pretty much phase out, and we just my wife and I both trade, and it's a lot easier to trade than do all this stuff. I enjoy doing things like this. I think I can help your listeners today. And when I do interviews, I hope that it can help people. I know it can because I get emails from people about it. But there's a point to let new blood come in and take over. I've been around the track a long time, and it really is time for new people and for Larry to just go back and do nothing but trade.
Yeah, sure. And is there anything else that you'd like to mention before we wrap up today?
No, just keep your eye on the horizon. Hold your head up high and don't be afraid to die. Enjoy the ride. Fear is what's going to grasp you in this business, and you just have to kind of get rid of fear. You got to say, hey, I've got my stops in place. What's going to happen is going to happen. I can't do a damn thing about it. I can't influence the markets. So once you have that perception, then you understand stops, targets, all that stuff. My basic theory is find a condition, find an entry, find the target, find the trailing stop. That's the model that has worked pretty well for Larry Williams and my students for over 50 years.
Oh, great. Okay, thanks. Well, thanks for the chat today, Larry. I highly recommend everyone head over to ireallytrade.com and see more of your work. Plus, there's published books, there's loads of webinars and interviews everywhere all over the internet. So there's plenty of material out there if you want to get to know more. But I'll also have a link to some of that in the show notes for this episode. So thanks again, Larry. It's been an honor to speak with you today. Thanks for your time and all the best.
Well, Andrew, thanks very much. I hope I've been able to help your listeners a little bit, and I'd like to wish you and all of them good luck and good trading.
Thanks a lot. Cheers, mate. Bye-bye. Thanks, Larry, for sharing so much with us this week. Here are two of my favourite insights from the chat. Larry likes to call himself a conditional trader. That is, he looks at conditions in the market using various tools, like the COT reports, seasonality cycles, etc. first, then he overlays entry and exit conditions based on those conditions. Charts don't move the market, conditions drive the prices, so the underlying condition needs to be determined first. I also like the analogy Larry used of trading should be like a combination lock. Larry likes to see 3 or 4 conditions to really get trades to work, like a combination lock where you need to get one number first, then you look for the second number, etc. until they're all lined up. That's when the lock opens. Larry does the same thing with his trading. He likes to see a number of conditions all line up to really get the trade to work. If you want to get more information about this episode, head over to the show notes at bettersystemtrader.com/20. We have links to additional content. Plus, as I mentioned before the interview, we have a huge giveaway to celebrate reaching episode 20 of the podcast. The main prize is an entire year's worth of trading books, but we also have a bunch of smaller prizes too, so head over to the show notes page on the website, that's bettersystemtrader.com/20. You'll find more details on the prizes and, of course, how to enter. Also, a big thank you to all the listeners who submitted questions for Larry this week. If you'd like the opportunity to submit your own questions to future guests, make sure you join the Better System Trader mailing list and I'll let you know when the next opportunity arises. Next week's episode, we have another trader who won the World Cup Trading Championship. He's a very successful trader, but he keeps out of the public eye, so you may not even have heard of him. However, his story is quite amazing, especially because he pretty much got wiped out by the PFG collapse and considered never trading again, but he managed to turn it around and now he currently trades over 100 different strategies. The insights he shares is fantastic, so don't miss that one. Anyway, I hope you enjoyed the chat with Larry Williams this week. Thanks for listening to Better System Trader, and catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.